All right, let's dive into the tile specialist, Hafary Holdings. Now, on the surface, their latest results look absolutely fantastic. But, as we're about to see, there's a really interesting story hidden in their numbers. And if you're an investor, it's something you definitely need to understand. So let's break it down.
So, here's how we're going to do it. First, we'll hit those big, flashy headline numbers. Then, we're going to peel back the layers and see what's really driving this business. After that, we'll pop the hood and check the health of their financial engine, scan the horizon for any potential risks, and finally, we'll boil it all down to what really matters, the bottom line for investors.
Okay, so at first glance, Hafary's performance for the 2025 financial year looks really solid. You know, all those key metrics that investors look at first, well, they're all pointing in exactly the right direction.
First up, let's talk about that top-line growth. Revenue climbed a super healthy 9.1%, jumping to almost $287 million. I mean, in today's market, that kind of growth is nothing to sneeze at. It tells us they're successfully selling more of their products and really expanding their footprint, exactly what you hope to see.
And here's the crucial part. That growth wasn't just happening at the top. The bottom line, the net profit, followed right along, up a strong 8.2% to over $31 million. And that is a huge signal, right? It means Hafary isn't just getting bigger, it's getting more profitable.
And here, you can really see the whole picture laid out. When you look at these numbers side by side, from revenue all the way down to net profit, you see this really consistent story of growth year over year. On paper, this looks like a slam dunk.
But where's all this profit actually coming from? See, the headline numbers look great, but they don't tell the whole story. To really understand what's going on inside Hafary, we need to break the company down into its different parts.
And this chart? Well, this chart reveals the real story. Hafary is essentially running two completely different businesses under one roof. On one hand, you have the general and project segments. These are the core sales divisions, and they are absolute powerhouses, just crushing it, generating nearly $60 million in earnings. That's before interest, taxes, depreciation, and amortization, or what we call EBITDA. But then, on the other hand, you have the manufacturing segment, and it's losing over $4.5 million.
So you see the picture, right? This is the crucial takeaway. Hafary is a company of two halves. You've got these incredibly powerful profit engines in the sales divisions, but all that excellent performance is being held back. It's being dragged down by this one part of the business on the manufacturing side.
Okay, so with this kind of mixed performance across the company, you gotta ask, right? Is the company's foundation actually solid? A great way to figure that out is to take a look at the cash flow statement. And wow, this is a major strength. Even with those losses in manufacturing, the company's core operations generated an incredibly strong $57.8 million in cash. To put that in perspective, that's more than double the cash they generated last year. This just goes to show you that the underlying business is an absolute cash machine. So, what they do with all that cash? Well, you can see here they were super smart about it. They followed a really balanced strategy. First, they paid down debt, which strengthens the whole company. Then, they reinvested back into the business to keep the growth going. And finally, they rewarded their shareholders with dividends. I mean, for an investor, this is exactly what you want to see. It's the sign of a really disciplined management team.
So the story so far is this. We've got a strong core business that's dealing with one pretty significant challenge. So as we look to the road ahead, what are the key risks an investor should really be keeping an eye on?
I'd say there are three big ones to watch. Number one, and this is the biggie, can they turn around that manufacturing division? Second, their inventory levels have grown. Now, managing over $124 million in stock is crucial because that's cash just sitting on a shelf. And finally, the company is really dependent on the Singapore market. That's both a strength and, a concentration risk.
So, we've looked at the good, the bad, and the potential risks. Let's bring it all together. What is the final, synthesized story for an investor looking at Hafary Holdings today?
Yeah, this is really the whole ballgame, isn't it? After you weigh the strong growth on one side and that operational drag on the other, what is the single most important thing you should walk away with?
And it all comes down to this central tension. You've got a fundamentally healthy, cash-rich company with a really disciplined approach to its finances. However, its full potential is being held back by this one underperforming segment. So the future of Hafary's story will likely hinge on one big question. Can they finally fix the manufacturing problem?
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.